Most retirees get their investment strategy completely backwards. They start with some generic allocation they found online, then try to build their retirement plan around it. It's like picking your clothes before checking the weather forecast. The old 60/40 rule, or the age minus 100 formula, or maybe a target date fund, they're all designed for the masses, not for you. But retirement isn't a spreadsheet problem you can solve with a cookie cutter advice. When your income shifts from steady paychecks to strategically withdrawing funds from your portfolio, following the wrong investment mix doesn't just hurt your returns, it can force you to choose between maintaining your lifestyle and running out of money in retirement. Over the last 15 years, my team and I have helped hundreds of clients navigate this exact transition. We've seen people make costly mistakes by following outdated rules, and we've watched others thrive by understanding what really drives smart investment decisions in retirement. The difference isn't luck or market timing, it's understanding the two critical forces that should shape every dollar that you invest. Miss these, and you could either run out of money or leave millions of dollars on the table at the end of your retirement. Get them right, though, and you'll soundly sleep knowing your money is working as hard as you did to earn it. Here's what most clients and even some financial advisors get wrong about investing for retirement. Before you can even think about setting your allocation between stocks versus bonds, you have to do some cold, hard math. In our world, we call this your risk capacity. It's your portfolio's ability to absorb losses without putting your future retirement income in jeopardy. This isn't about feelings or comfort levels, it's about objective, numbers based reality. Think of it as the foundation of your financial house. You can't build anything without a solid foundation. So, how do we figure out what your risk capacity is? We start by calculating exactly how much money you'll need to live on each year in retirement. Then we look at your guaranteed income sources. These could be things like Social Security, pensions, and maybe an annuity if you have one. Then we subtract those guaranteed income sources from your total needs, and what's left is the gap that your portfolio has to fill in retirement. That gap is everything. It tells us how much risk your plan can actually handle. Once we know your annual withdrawal needs, the next step is critical. We identify how much of your portfolio should be set aside to fund those withdrawals over the next 5 years. At our firm, we recommend what we call a spending bucket. This covers at least 5 years of planned retirement withdrawals in high quality liquid investments. We're talking about things like bonds, short term treasuries, and CDs, not junk bonds or long term dated government bonds that could potentially be risky. The stuff that is very conservative and we know will be there for us when we need it. Why 5 years? Because history shows us that most bear markets recover within that time frame. If you look back at actual data going back to 1950, the average recovery time from market peak back to the same peak is about 33 months, or roughly 3 years. 5 years gives you a comfortable cushion. It should be enough to weather even a longer than average downturn without forcing you to sell your growth investments at the worst possible time. Now, let me be crystal clear about something. This spending bucket isn't there to make you rich. It's there to protect you. It gives you the luxury of time. When the market crashes and everyone is panicking, you can sit back and let your more aggressive investments recover while you live off this safe spending bucket. This is how you protect yourself from sequence of returns risk, which is one of the most dangerous threats to your overall retirement. When you back test this approach through previous nasty market downturns, the results speak for themselves. But here's where it gets interesting. Once you've handled the math and built this solid foundation, you need to ask a completely different question. How much risk can you handle emotionally? This is what we call risk tolerance, and it's trickier than most people think. Unlike risk capacity, which is about your plan's ability to withstand losses, risk tolerance is about your ability to stay calm and stay invested when your account balance is dropping substantially. I like to call this your freakout number. It's the point where the market losses become so uncomfortable that you feel the overwhelming urge to sell, even when logic tells you not to. This term comes from experiences from the great financial crisis in 2008 and 2009. I have witnessed and saw firsthand how even the most well designed plans can fall apart when someone panics and abandons their overall retirement strategy. Here's how I walk people through this exercise. I use real dollar scenarios, not vague percentages that don't mean anything. So, let's say your portfolio is worth $2 million, and I asked you to imagine logging in to your account and seeing it down 200,000. That's about a 10% drop. How would you feel? Most people say it's not great, but they can live with it. Then I push further. What if it's down $400,000? That's a 20% drop. Usually they'll say something like they'd want to talk to someone, but they'd probably stay the course because they've been there before and seen this. But then I keep going. What if it's down 600,000 or even 800,000? Now you're talking a 30 to 40% loss of your portfolio. This is where the conversation starts to shift. You'll see one spouse that gets the panicked look while the other one digs their heels in. And when I ask about a full 50% drop, $1 million gone from your investment portfolio, that's where most people start to hit their limit. And that's their freak out number. This isn't about what you think you can tolerate or some online questionnaire. It's about how you'd actually react when forced with real losses in real time. Everyone's different. Some people can ride out a 50% drop because they've lived through it many times before, where others, they're not able to. But here's the thing. Back then, they probably had less money at stake, or they were still working and adding to their investment accounts. Once you retire, your relationship with risk changes completely. Some people can handle major market volatility, while others would bail out long before hitting those extreme losses. Neither approach is wrong, but you need to know your limits before the market tests them. Once you understand both your risk capacity and your risk tolerance, you can combine them to create your own personalized investment allocation in retirement. Risk capacity sets your floor. It tells you the minimum amount of safe investments your plan needs to be secure. Risk tolerance sets the ceiling. It defines the maximum amount of stock exposure that you can handle without losing sleep at night or making those dreaded emotional decisions. Let me give you a sample example. Say your plan only requires 20% in bonds and safe investments to meet your income needs over the next 5 years. But emotionally, you know that you'd panic with anything more than 60% in stocks. Your actual allocation should probably be closer to 60-40, but not because some article told you, but because your psychology demands it. You can only stretch as far as the more conservative of the two allows. Here's why this matters so much. If your allocation ignores your risk capacity, you could run out of money in retirement. If it ignores your risk tolerance, you could abandon your plan during the next market crash. Either way, the results are potentially devastating. But when you respect both forces, when your plan is backed by solid math and your emotions are counted for, you give yourself the best chance to succeed in retirement. That's when your allocation becomes something you can stick with through all market environments. You might be wondering to yourself why we go through all this complexity. Why not just pick a balanced fund and call it a day? Here's the simple truth. The best portfolio isn't the one with the highest returns on paper. It's the one that gives you the ability to stay invested, not just during bull markets, but during those brutal bear markets too. At our firm, that's exactly how we build clients' retirement portfolios, not based upon some generic questionnaire or outdated rules of thumb, but based upon you and your specific plan, your actual numbers, and your real mindset. Building the right investment mix isn't just about crunching the numbers, it's about knowing yourself. Your risk capacity tells you what your plan can handle mathematically. Your risk tolerance tells you what you can handle emotionally. The magic happens when we combine those two forces together, creating an allocation that's both financially sound and psychologically sustainable. This is how you build an all weather portfolio that can withstand whatever the markets throw at you. Now that you understand the two forces that drive these smart investment decisions in retirement and why personalized advice beats generic every time, but knowing the right mix is only half the battle. How do you actually structure these investments to create reliable income that will last decades? Most retirees treat their portfolio like it's one big pot of money, but that leaves you vulnerable to market crashes right when you need the income most. Click right here to watch our next video on how to build a 3 bucket retirement income portfolio to discover the proven system that separates your money into 3 distinct buckets, each designed for different phases of retirement. This strategy could be the difference between running out of money and having the income that grows with inflation for life.